Options trading can seem complicated at first glance, especially with all the jargon and technical terms involved. However, once you break it down, it's much more approachable than it initially appears. At its core, options are simply contracts. These contracts give you specific rights regarding an asset, typically a stock. More specifically, these contracts grant you the right, but not the obligation, to buy or sell an asset at a predetermined price. This asset is usually a stock, but options can also be written on other financial instruments like indices, commodities, or even currencies. The price at which you can buy or sell the asset is known as the strike price. This is a crucial element of the options contract. The strike price is predetermined and is a key factor in your decision-making process when trading options. Another important aspect is the expiration date. This is the date by which you must exercise your right to buy or sell the asset. There are two main types of options, calls and puts. Each serves a different purpose and can be used in various trading strategies. A call option gives you the right to buy an asset at the strike price. This can be advantageous if you expect the asset's price to rise. The strike price is the price at which you can purchase the asset, and this must be done by the expiration date. Timing is crucial as the option must be exercised before the expiration date to be valid. On the other hand, a put option gives you the right to sell an asset at the strike price. This can be useful if you anticipate the asset's price will decline. Again, the strike price is the predetermined price at which you can sell the asset, and this must also be done by the expiration date. Just like with call options, the timing for put options is essential, as they must be exercised before the expiration date. Traders use options for a variety of reasons. Some use them to speculate on the future direction of asset prices, while others use them to hedge against potential losses in their portfolios. Speculation involves taking on risk in hopes of making a profit, while hedging is about reducing risk by taking an offsetting position in a related asset. But today, we're focusing on income strategies. These strategies aim to generate regular income from your investments, often through the use of options. Income strategies in options trading aim to generate income. This is done by selling options premiums. Premiums are the fees received when selling options contracts. One such income strategy is the covered short straddle. This strategy involves selling both a call option and a put option. But here's the catch. Both options have the same strike price and expiration date. The term covered in covered short straddle means the options writer owns the underlying asset. This underlying asset is usually the stock of the company. Let's break down how a covered short straddle works. First, you need to own shares of the underlying stock. The number of shares must equal the number of options contracts you plan to sell. Next, you simultaneously sell or write both a call option and a put option. These options should have the same strike price and expiration date. By selling these options, you receive premiums. This is your income for the trade. The maximum reward in a covered short straddle is limited. This strategy involves selling both a call and a put option on the same stock, with the same expiration date and strike price. The premiums received from selling these options represent the maximum profit potential. It's capped at the premiums received when selling the call and put options. This means that no matter how favorable the market conditions might be, the profit cannot exceed the total premiums collected. This maximum profit occurs when the stock price remains relatively stable. In an ideal scenario, the stock price hovers around the strike price until the options expire, allowing the trader to keep the premiums without any further obligations. Ideally, this happens near the strike price at expiration. The closer the stock price is to the strike price at expiration, the more likely the options will expire worthless, maximizing the trader's profit. However, the maximum risk is theoretically unlimited. This is because the trader is exposed to significant downside risk if the stock price moves unfavorably. This is on the downside, below the strike price. If the stock price falls significantly, the trader could face substantial losses. This happens if the stock price falls significantly. The trader may be forced to buy the stock at the strike price, which could be much higher than the current market price. Why is the risk unlimited? The primary reason is the short put option, because you are short a put option. This means you have an obligation to buy the stock at the strike price if the option is exercised. And if the stock price falls, you may be obligated to buy more shares at the strike price. This can lead to significant financial exposure. This could result in significant losses if the stock price continues to decline. The trader must be prepared for this potential outcome and have a risk management strategy in place to mitigate these losses. Ideal market conditions for a covered short straddle. The ideal market condition for a covered short straddle is a relatively stable market. You are betting that the underlying stock price will not move significantly. This strategy thrives in low volatility environments. That's because the premiums received for selling the options will be higher. A bullish stock outlook is generally preferred for this strategy. This is because you already own the stock, and you want to benefit from potential stock price appreciation. Risks associated with covered short straddles. Despite its potential for income generation, the covered short straddle is a high-risk strategy. The unlimited risk potential on the downside makes it unsuitable for most novice investors. Moreover, while a stable or slightly bullish market is ideal, unexpected market events can lead to substantial losses. For example, a sudden market downturn or negative news about the company can send the stock price plummeting. This can quickly erase any premiums received and result in a significant net loss. Chevron Oil Company example. Let's illustrate the covered short straddle with an example using Chevron Oil Company, ticker symbol CVX. This strategy can be particularly useful for investors who already own the stock and are looking to generate additional income through options trading. Imagine CVX is currently trading at $170 per share. This is a hypothetical scenario, but it helps to understand the mechanics of the strategy. You own 100 shares of CVX. This ownership is crucial because it allows you to sell covered options, which can reduce risk compared to naked options. You decide to sell one covered short straddle. This involves selling both a call option and a put option on CVX. This means selling one call option and one put option with the same strike price and expiration date. The strike price is the price at which you agree to buy or sell the stock if the option is exercised. You choose options with a strike price of $175 and an expiration date 1 month out. This means you are committing to this strategy for the next month. For selling these options, you receive a total premium of $500. This premium is the income you earn for taking on the obligation to buy or sell the stock at the strike price. Your maximum profit is capped at this $500, regardless of how high CVX's price rises. This is because the call option you sold limits your upside potential. However, if CVX's price drops significantly, say to $150, you could face significant losses due to your short put option. The put option obligates you to buy the stock at the strike price, which could be much higher than the market price, leading to substantial losses. Therefore, it's essential to understand the risks involved and have a risk management strategy in place. This could include setting stop-loss orders or having a diversified portfolio to mitigate potential losses. Diversification can help spread risk across different assets, reducing the impact of a significant drop in any single stock. By understanding and managing these risks, you can make more informed decisions and potentially enhance your investment returns. Conclusion. The covered short straddle can be an effective income-generating strategy in options trading. However, it's crucial to remember that it comes with significant risk, unlimited risk on the downside, to be precise. Therefore, this strategy is best suited for experienced options traders. These traders have a high risk tolerance and a thorough understanding of the underlying stock and market conditions. Before employing a covered short straddle, consider your investment goals, risk tolerance, and overall market knowledge. Disclaimer: I cannot give financial advice. Options trading involves significant risk and may not be suitable for all investors. Before making any investment decisions, be sure you know what you are doing. Check out my video with the live trade. Thanks for now.